Karen, thanks for joining us. You recently wrote a note about the increased retail investor participation. It's clearly on full display today and the last few weeks and even months. How does that change the entire equity market?
Well, any market is driven, of course, by buyers, sellers, and how they think about the market, how they respond to changes in conditions. And in most of the world, investors really haven't had to think a lot about retail participants because they haven't been a meaningful part of the market. It was a small enough piece that you could mostly ignore it. And if you're thinking about buyers and sellers, think about other buyers and sellers. That's very quickly changing because pipes are being laid down all over the world to enable this sort of retail participation. And while the Robinhood story, these meme stocks we're talking about are discussed a lot, what's discussed less is how global this issue is. And one way to think about what this means for the market is to look at the market that's had the most retail participation, which is China, which is actually dominated by retail participation. And you really see the type of, being more prone to boom bust cycles activity when you look at that market. And so what seems clear right now is that while these pipes are being laid down everywhere, you're going to have retail investors with this access, and they might get hot or cold a particular week, but that infrastructure is there to allow them to just be a bigger player, having a different kind of effect than before.
So what is a long-term investor supposed to do with that?
Well, I think that any long-term investor should be, doing the same thing they've always done, which is ask themselves, what exposure do I want? How do I think about valuations? But also, how do I think about what are the types of factors that drive valuation, drives prices further and closer from their fair value? And at the end of the day, it's players that drive assets further and closer to fair value. Someone has to buy or sell for the price to move. And you have to be asking yourself, who are the players in any market that you're in? And so in the stock market, as retail investors kind of concentrate in different corners, you have to ask yourself in the corner that you're in, how big of a role are retail investors playing? And if they're playing a big role, you have to predict their moves, how likely are they to go in or out? And that can happen for more macro reasons, like checks get shipped to them, or for reasons that you may feel you can't predict, like what's going to happen on some Reddit forum.
But surely, Karen, that implies that the only trading that ever goes on is trading where you're just hoping to find a buyer for your asset at a higher price in days to come, as opposed to traditionally investing for discounted cash flows. I mean, surely this would suggest that if no one is trading for discounted cash flows, you're going to find some bargains. You might not get AMC type 100% returns in one day, but you have a surefire way of getting those sort of 10% annual returns if that's enough for you.
Absolutely. And so you'd want to be saying, what do I think the underlying cash flows are, as you're saying, what's the value here? And still ask the question of, well, what will happen likely to the traded price? If you're not holding it forever, you still want to know what's the multiple I'm likely to see on this, maybe in 5 years, maybe in 10 years. And that depends on who the holders are. And so most stocks that you're talking about that have these high cash flow yields are not stocks where this retail trade is a major part of the volume. And so if you're doing what we call a flows analysis, thinking who are the buyers, who are the sellers, what's likely to occur in terms of buying and selling, they probably wouldn't be a big part of your calculus. Of course, if you're an AMC, that's maybe the most important part of your calculus.
Shepard Smith here. Thanks for watching CNBC on YouTube.